In 1637, a single tulip bulb sold for more than a luxury Amsterdam canal house. Not the flower, the bulb. A small brown underground lump, worth a house. People traded their farms, their life savings, and their futures to own one. Then, in February 1637, the price collapsed in a matter of days. Most people were left holding contracts for bulbs worth a fraction of what they paid. Tulip Mania is the oldest documented speculative bubble in recorded history. It has been cited in every financial crisis since to explain how bubbles work. Everything you need to understand about speculative manias starts right here. Let's rewind. To understand Tulip Mania, you first need to understand why tulips were so special. The tulip was not native to the Netherlands. It arrived from the Ottoman Empire, specifically from the mountain meadows of Central Asia and present-day Turkey. It arrived in Western Europe in the 1550s, introduced by the Flemish ambassador to Turkey. European botanists had never seen a flower with such bold, vibrant, symmetrical beauty. Most European flowers at the time were small, pale, and relatively unremarkable. The tulip was large, intensely colored, and came in an extraordinary variety of patterns. It became an immediate status symbol among the European aristocracy and wealthy merchant class. In the Netherlands specifically, tulips became associated with wealth and good taste. Having rare and exotic tulip varieties in your garden was the ultimate social statement. And some tulip varieties were dramatically, almost impossibly more beautiful than others. Specifically, the broken tulips, flowers with dramatic, irregular, flame-like color patterns. Here is the extraordinary scientific twist at the heart of the entire Tulip Mania story. The most beautiful and sought-after broken color patterns were caused by a virus, specifically the mosaic virus, transmitted by aphids between tulip plants. The virus caused the tulip's pigment to distribute unevenly through the petals, creating the extraordinary streaked, flamed, and feathered patterns that collectors craved. The Dutch did not know this. They had no concept of viral plant disease in 1630. They knew only that broken tulips were rare, unpredictable, and extraordinarily beautiful. You could plant a regular tulip bulb and sometimes, unpredictably, a broken flower would emerge. This unpredictability made broken tulips feel almost magical to Dutch collectors. And magical things that are also beautiful and rare tend to attract extreme prices. By the 1620s, a robust and legitimate market for rare tulip bulbs had developed. Wealthy Dutch collectors, botanists, and merchants traded bulbs at reasonable premium prices. The Netherlands in the 1620s and 1630s was the wealthiest nation on earth per capita. The Dutch Golden Age was producing extraordinary merchant wealth across all social classes. The Dutch East India Company, the VOC, was generating enormous returns for investors. Dutch citizens had more disposable wealth than almost anyone in the world at this moment, and they needed somewhere interesting and potentially profitable to put that wealth. Starting around 1634, the tulip market began attracting a very different type of buyer, not collectors who loved tulips, speculators who loved rising prices, people who didn't particularly care about flowers, but cared very much about profit. A critical financial innovation made the mania significantly worse than it might have been. Tulip bulbs grow underground and are only available to dig up in summer months. For most of the year, you couldn't actually buy or sell the physical bulb itself. Dutch traders solved this by inventing tulip futures contracts in the winter months. A futures contract. Pay today for a bulb that will be delivered next summer. This allowed tulip trading to continue year-round, regardless of the growing season. It also meant you could trade something you had never seen and would never receive. because most futures buyers were not intending to actually receive the physical bulbs. They were buying to sell at a higher price before the delivery date arrived. Pure speculation. No tulips required. Just contracts and rising prices. From 1634 to early 1637, tulip prices rose with extraordinary and accelerating speed. The price of common tulip varieties rose by approximately 1,000% in 3 years. The most sought-after varieties rose by far more than that. Incomparably more. The Semper Augustus was the single most expensive and coveted tulip variety of the era. A white tulip with extraordinary red and purple flame patterns running through each petal. At peak mania, a single Semper Augustus bulb sold for 10,000 guilders. 10,000 guilders. A skilled craftsman in Amsterdam earned approximately 300 guilders a year. One bulb cost 33 years of a skilled worker's entire annual income. A luxurious Amsterdam canal house at that time cost approximately 10,000 guilders. One Semper Augustus bulb. One canal house. Exactly the same price. Other extraordinary price records from the peak of the mania have been documented. One documented transaction, 12 acres of farmland exchanged for a single bulb. Another, a new carriage, 2 gray horses, and complete harness for one viceroy bulb. The viceroy trade included additional goods, beds, clothing, wheat, butter, cheese. Approximately 2,500 guilders worth of goods in total, for one single flower bulb. Who was buying at these prices? Not just wealthy merchants and aristocrats. By 1636 and into 1637, ordinary Dutch citizens were participating in the tulip market. Weavers, cobblers, farmers, chimney sweeps, all buying tulip futures contracts. They borrowed money against their homes, their tools, and their livelihoods to participate. The logic was simple and compelling. Prices had been rising for 3 years without stopping. Everyone who had bought 6 months ago had already doubled or tripled their money. The people who hadn't bought were watching their neighbors get rich and feeling left out. This is the core psychological mechanism behind every speculative bubble in history. Not greed alone. The fear of being the only person who didn't get rich. Tulip Mania was this mechanism in its purest and most historically documented form. The peak of Tulip Mania occurred in the winter of 1636 into 1637. Trading was happening in taverns across the Dutch countryside, rather than formal markets. Buyers and sellers meeting over drinks, exchanging contracts by candlelight in the evening. No formal exchange, no regulation, no mechanism to enforce delivery of contracts, just handshakes and paper contracts between ordinary Dutch citizens in village taverns. The prices being discussed in these taverns were genuinely extraordinary by any measure. A pound weight of the rare Switzer's variety sold for 1,500 guilders at peak. The Gouda variety reached 920 guilders per pound at the height of the mania. Even common varieties that anyone could grow were selling at previously unthinkable prices. In January 1637, prices were rising so fast they were changing within single trading sessions. The velocity of price rises was itself attracting more buyers expecting more velocity, a classic feedback loop, the same one visible in every subsequent speculative bubble. And like every feedback loop, it had a termination point that nobody could predict. That termination point arrived on a winter morning in Haarlem, February 1637. A scheduled tulip futures auction attracted significantly fewer buyers than expected. The auctioneer opened bidding on a batch of common tulip bulbs at their expected price. No one bid. The price was dropped. Still no one bid. The price was dropped again. Something had shifted in the market. The certain expectation of rising prices had broken. Word spread from that Haarlem auction across the Netherlands in days. If the prices were no longer rising, the only rational thing to do was sell immediately. Everyone who had been buying now had the same thought at approximately the same time. The tulip futures market collapsed in days, not weeks, not months, days. Within 1 week of the failed Haarlem auction, prices had fallen by approximately 90%. 90%. In 1 week. A Semper Augustus worth 10,000 guilders was now worth 1,000. Within weeks, some bulbs were worth less than the price of a common onion. The chimney sweeps and cobblers and farmers were left holding contracts worth almost nothing. Contracts they had paid for with borrowed money against their homes and livelihoods. Many could not pay their debts. Sellers who had sold futures couldn't find buyers who could pay. The Dutch courts were petitioned to help resolve the contracts. Their answer was decisive. Courts declared the tulip futures contracts effectively unenforceable gambling debts. This meant sellers who had promised to deliver bulbs could simply refuse to do so, and buyers who had contracted to pay couldn't be forced to pay either. The entire futures market was rendered legally void. The contracts were worthless paper. Those who had sold actual physical bulbs and received payment were the only real winners. Everyone else was left with losses ranging from modest to completely devastating. The Dutch government's response to the Tulip Mania collapse was measured and pragmatic. They did not attempt to bail out those who had lost money in the collapse. The prevailing attitude, if you speculated and lost, that was your own responsibility. The broader Dutch economy did not collapse as a result of Tulip Mania. This is an important nuance that is often overlooked in popular retellings of the story. The Dutch economy was diversified, robust, and globally connected enough to absorb the shock. The participants who lost most badly were those who had speculated with borrowed money. Those who had bought with cash they could afford to lose absorbed the blow more easily. The ordinary tulip, the common varieties, continued to be grown and enjoyed after the crash. The Netherlands remains to this day the world's largest exporter of cut flowers. Here is something important. Historians now debate how severe Tulip Mania actually was. The most dramatic accounts of Tulip Mania come primarily from one single source, a series of satirical pamphlets published in 1637, mocking the tulip speculators. These pamphlets were written to mock and moralize, not to objectively document prices. Some modern economic historians argue the mania was more limited than commonly portrayed. Economist Peter Garber argued in 1989 that most of the extreme prices were for rare bulbs, and that the common tulip market, while elevated, was not irrationally priced throughout. Whether or not the full narrative is accurate, the lesson it teaches absolutely is, because the mechanisms visible in Tulip Mania, real or embellished, recur constantly. The story's truth as a parable exceeds its truth as precise economic history. The Mississippi Bubble of 1720 followed the same mechanism. Different asset, same logic. The South Sea Bubble in England, also 1720, followed the same mechanism again. The dot-com bubble of 1999 and 2000 followed the same mechanism. Different asset. The U.S. housing bubble of 2005 to 2008 followed the same mechanism. Different asset. Cryptocurrency markets in 2017 and 2021 followed the same mechanism. Digital asset. The specific asset changes every time. The human psychology never changes at all. Every bubble contains the same 4 ingredients in the same sequence every time. First, a genuinely new and interesting asset that people haven't seen before. Second, a rising price that creates visible proof that earlier buyers are getting rich. Third, easy access to credit that allows people to buy more than they can actually afford. Fourth, The widespread social belief that this time is genuinely different from before. It is never different. The tulip was just the first documented version of the recipe. In 1637, the asset was a small brown underground lump that became beautiful in summer. Everything that has happened in financial markets since traces a direct line back to it. The bulb is gone. The mechanism it revealed is permanent. It has never left.
If you enjoyed this story, subscribe for more finance disasters, market crashes, and billion-dollar mistakes that changed history. The next one is even crazier.